Loan officer training series with the mortgage calculator. Appreciate you tuning in. Today we're going to go through a training on condo review basics. We'll wait just a minute here to get started to go live on all the different platforms. Thank you for tuning in early though. Go ahead and drop a comment there. We put the comments up on the screen, so feel free to drop a comment there in the chat as you tune in. Also, feel free to drop any questions as we go through the training here today. Well, we'll get started in just a moment. Thank you for the comments, everyone. Jason, John, Adam, appreciate the comments there. Roger, appreciate it. Hope everyone's having a good evening. All right, it looks like we are good to go. We are live on all the different platforms, so we can go ahead and get it started here. We'll take the chat off the screen, but please continue to drop any questions that you have in the chat there. We'd be more than happy to answer questions. So welcome everyone to the Loan Officer Training Series with the Mortgage Calculator. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday, 7 p.m. Eastern time, is go through different loan officer trainings. And today's training is going to be on condo review basics. Now, some of you may never run into a condo, but it's good to have this knowledge. And some of you may be doing a ton of condos if you're in South Florida like we are, or one of the places in more of a downtown area where there's a lot of condos. So this is a great training, and everybody needs to be aware of the different moving pieces here with condo reviews here. So I'm going to go ahead and turn it over to Jose, our sales manager with 28 years of experience as a loan officer and a realtor here in South Florida. So he knows all about the condo reviews, and I'll let him take it over from here.
Yes, sir. This is like my 28-year anniversary, I think, was in these few days. It was like in the middle of September when I got my 1995 when I got my license. So condos, very popular form of ownership, property ownership. Now, condos are not to be confused with co-ops, right? That's a totally different type of structure. Co-ops are much less popular, tend to be very popular in the Northeast, especially like in New York City, and a little less popular in some areas of Florida as well, but not very popular. So do not confuse condo with co ops. What we're talking about today is strictly for condominiums. Now, one thing I will also state is that condos are not treated equally in all states, right? So, Florida, having a high percentage of condo buildings compared to a lot of other states is a little stricter with their condos. We've had an issue that when the real estate dip happened in 2008, 2009, a lot of people stopped paying on their condos. Condo associations stopped collecting association monthly assessments, and a lot of these buildings became, non-FHA and non-Fannie Mae approved, and still some of them are still not meeting the guidelines due to reasons that I'm going to show you in this presentation. So do look at your guidelines on your agency loans and do pay attention to Florida versus the rest of the US, because as I'm going to bring up in this presentation as well, the guidelines are a little stricter on condo review for Florida than they are in the rest of the US. So let's get right into our condo review basics. Now, I guess as I was giving you a little insight right now, it's good so that you understand, where we're coming from, a little bit of context to what is a condominium, right? In a condominium, owners own a percentage of the whole proportionate to their unit size, right? So you'll always see when you're looking at the legal description of a condo, it'll say unit 106, 0.1657% interest in the ABC condo community type of deal. So, if it's one of 10 units, you own 10%. One of 100 units, you own 1%. Keep in mind that when you are dealing with a condo where you may be in a community where you see multiple buildings in one community name, keep in mind that most of the time each individual building will be an association, will have its own separate association. So that's good a lot of times because some may be in better financial situation than others. So that's why you'll see sometimes in financing options differences like that, and that's going to be. So don't assume because somebody in building A was able to finance with 5% down that you'll be able to finance somebody in building B with 5% down as well. You'd have to go through the whole process that I'm going to explain shortly. Condominiums have covenants, declaration of condominiums, along with rules and regulations that govern them and determine their policies and procedures. The owners elect a board that may delegate the operations of the community to a management company, or they may decide to self-manage. Most of the time, self-managing is good unless they're stealing everything they can get. Um, the association administers the community and determines the necessary budget. So that's something to consider because that's one of the big stumbling blocks in these condo reviews because the owners, and notice I have there currently, because for example in Florida after we had a building recently collapse within the last couple of years in Surfside, which is in a beachfront village in Southeast Florida, they've been voting on a lot of different referendums, and one of them is going to require after 2025 that buildings collect a reserve requirement. They're no longer going to make it optional. So keep that in mind because there's gonna be an earthquake in the condo market when that finally comes into play, because a lot of places that are not collecting reserve requirements are going to have their budgets increase substantially, and deferred maintenances are also requiring them to do um, structural engineer reports to identify any deferred maintenance issues, especially structural related components, and they're going to have to be taken care of, regardless of if the building already completed their 40-year certification or not. They're going to have to take care of that, and that is also going to be additional assessment. So, there's going to be some changes that are going to affect the affordability of condos. So, but owners currently can vote on budget items such as the reserve requirement. They can still vote on budget items, but pretty soon reserve requirement is not going to be on that list. And with that being said, inadequate reserves is the main reason that a condo project will not qualify for a full review condo loan. So it's important that you're aware of how, just this whole condo ownership, how it works, and what can affect the unit value and what can affect the unit financeability. Obviously, if your unit can get 3 or 5% down financing, you're going to have a condo that's going to maintain its property value. If your unit has issues like that, then you're going to have a lower pool of buyers and borrowers, and you're going to have issues with property valuations. Now, what are our condo review options? Well, we have the full review, which requires a more in-depth review of the association financials and ownership breakdown, among other things. We have the limited review, which does not require a review of the budget and requires a less detailed review of ownership breakdown and of the association financials. You cannot close a condo loan without some type of review. I mean, I guess you could close a hard money loan, I guess, without condo review, but you're not gonna close an agency loan, and you're not gonna close a non QM loan, condo loan, should I say, without either a full review or a limited review. Now, non QM will follow Fannie Mae guidelines for condo reviews for most things, but I'll show you a couple of exceptions a little bit later on. Now, please do know, real important here, before you go off on a wild goose chase and realize that condo reviews are not required for detached condos nor 2 to 4 unit condos. Now, you may ask, what is a detached condo, right? Because that sounds weird. And I've actually financed a detached condo. It looks like a single family home, right? I mean, exactly. If you didn't look at the legal description, you would never know that it's a condo. Except in a condo, the unit owners own, collaboratively own everything outside the walls, right? So if you have a detached condo, you don't own the your backyard, even though it may be fenced in. It's not yours. You don't own the land that the unit sits on. The land is owned by the unit owners as part of the everything that they own, common areas and everything like that. So, but just note, there are a couple of things that they will review on these condos. They're going to have to review the association. Excuse me, the insurance. It's going to be one of the main things. They're going to review the insurance to see if that's in play. But you're not gonna be required to do the condo questionnaire. That's really important to note.
So, Jose, we're basically saying here, I have a client, they have a condo. This comes into play right away, right? It's going to be some type of review, whether we're going conventional, FHA, VA, USDA, non-QM, unless we're doing some kind of private hard money thing. This is every file where we have a condo, right? That's what we're saying here.
Absolutely. So you should make sure that you are in good communication with the buyer's agent, because that's going to be the individual that's probably going to help you obtain success in this process. The buyer's agent, and in some cases you may have to even reach out to the listing agent if there's issues with this. And I'm talking about the answering of all the questions, including, now there's a section on the questionnaire that covers structural integrity on these full reviews that some associations are balking at completing. And if any section of this questionnaire is not completed, your loan is not going to close. They're not going to give you the clear to close if they don't complete that, any section. And we recently had a loan like that luckily the MLO was able to reach out to everybody in the transaction, and was able to have one of the real estate agents reach out to the association president and have him complete that section of the form after they explained the urgency of the matter of not being able to close. So yeah, definitely every single loan is going to need a full or limited review. So we should definitely make sure that we have all the information we need on where to obtain the necessary form. Because we have, for example, a service that will reach out and do it for you, right? But on top of that, there's a couple of other websites that are out there where most of the associations require you to go. So you could check on one of those to see if the association appears or not. But you may have to, have the agent give you the contact info so you can follow up with the management company or the association to see what exactly is their procedure for completing the form, and what is the cost also of completing the form. And with cost being said, there is a cost for the condo questionnaire. So when you do have a condo, you need to disclose a condo questionnaire cost, right? Because we require that form. It's a required document. So there has to be a fee. So, we always recommend to over disclose the amount because it may be a couple of days, unless you already determined the cost up front before you disclose your file. Then that's great. That would be the ideal thing. But just note that there is a fee. It is a borrower paid fee, and we do want to have an accurate amount. So, excuse me. So as we just stated, the full review is required to qualify for low down payment options. Like I was mentioning a little bit ago, having a building that will qualify for a full review, I mentioned, will probably give you a higher value appreciation for the condo unit because you're going to have a higher pool of available buyers because you have low down payment options. It's not 25% down kind of a situation. You can go with a 3% or 5% down as long as you can satisfactorily meet the requirements of the full review, right? So uh, some of the things you're going to need, for example, you are going to need the current association budget and the financial statements. And you do need, like I was just alluding to, the full form condo questionnaire, right? Somebody who's authorized to complete that form, whether it's the association or whether it's the management company or whether it's this third party that they use, somebody has to complete the condo questionnaire. And let me highlight some of the issues that you may have that can cause you to have to seek the alternative limited review, right? Where you can have no more than 15% of the units 60 days or more past due on payment of the monthly assessment, nor any special assessment that may be in place. Uh, the association, this is one of the ones that kills most of the associations down here. The association must be collecting reserves equal to at least 10% of the annual budget, right? So that's really important to note. At least 10% of the annual budget has to be collected and be collected in the monthly fee. They have to have a separate reserve account that's going to have a balance also of at least 10% of the annual operating budget of the building, of the association, of the building. That's really important to note. At least 50% of the units need to be primary and second homes. That means you can't have more than 50% of the units uh, that are being used as investment properties, tenant occupied properties, rental units. Can't have more than 50%. The commercial space, if there is commercial space in the building, cannot exceed 35% of the total space of the building. There is a question on litigation now. So if if litigation is in play, then review of the lawsuit documents will be required. So you would have to obtain documentation from the association or management company because underwriting is probably going to want to review that, and they'll also probably want to know then, depending on whatever may be the contingent liability from that lawsuit, if the association has the necessary reserves and insurance to cover any negative outcome. If the result is that they're responsible for whatever they're being sued for, and they're going to have to pay out, do they have the money to cover that, and the insurance also to help with the expense? So just because there's litigation doesn't mean you're disqualified. But if there is litigation, then you got to obviously have additional review. Now, if there's litigation by the association against somebody else because they're collecting money owed to them, that won't matter. what they're really more concerned with is litigation against the association. No single entity, if you have 21 or more units in the building, no single entity may own more than 20% of the units. If you have 5 to 20 units in the building, no single entity may own more than 2 units in the building. So that one can be tricky. And obviously, 1 to 4 units doesn't matter because we already mentioned 1 to 4 units are exempt from that type of review. And also, they are going to be really picky about insurance. So the association will need to be fully insured. The building for liability, for property damage, structure, all that kind of stuff, plus fidelity bonds and a few other types of insurances that they require the association to have. Flood insurance also. That's a big one. A lot of times they don't have adequate flood insurance, and the unit owner has to purchase on a condo, believe it or not, their own separate condo flood policy. So limited review, right? So if you identify these issues, and I guess let me back up a second so you can keep looking at those, but if you know that these are going to be pinch points in your transaction, in any transaction that you may have with a condo, now you have to be proactive and find out in the initial stages of structuring your loan if any of these points are going to be an issue for your deal. You got to reach out to the real estate agents, right? Do your due diligence, get as much information, have the buyer's agents see if they can obtain a copy of the budget and the financial statements. The sellers will usually provide all of that. They should be able to easily obtain that if they don't have their copy. They can obtain that from their association or the management company, so that you can get that up front and review it and see if the needed reserves is there. See if anybody has any insight on the percentage of renters or any of these other potential obstacles to getting your full review. And if you do identify that it is an issue, now you know then that you have to properly structure your loan, right? That's where the limited review comes into play, because the limited review is more streamlined, right? It's a workaround to associations with weak financials and or a high percentage of rental units. And those are things that are very prevalent in markets like Florida, where we have desirable areas for renting, close to touristy type areas and stuff like that. So definitely can be an issue and something to be aware of. The limited review is going to resolve then your low reserve budget issue. It's going to resolve the high percentage of rental units issue. It's also going to resolve the high concentration of units to one owner issue, right? I mean, those are the ones that kill a lot of deals. Full insurance is still required. Litigation is still a concern. Now, the LTV limits here, like I was telling you earlier in the presentation, are different for Florida than the rest of the country. So, in the rest of the U.S., except for Florida, the max LTV for a limited review condo loan is 90%, which sounds pretty good to anybody in Florida, right? 90%, because except for Florida, which is 75%, a little bit higher risk, they hedge their risk accordingly. Fannie does and Freddie does by having the lower LTV. So Florida is 75% max on the limited review for a primary home, and the rest of the country is 90% for a primary home. Second home across the board, 75%. So max LTV on a second home limited review condo loan is 75%. And on an investment property, max LTV for limited review is 75%, except for Florida, which is 70%, right? So this is all great to consider because, at the mortgage calculator, one of the things we love doing is we love providing solutions to what other people may consider, problems. To us, we just look at it as a challenge that we have solutions for, right? So obviously, the limited review is a great way to get that, nice condo, especially when you can combine it with a HELOC up to a 90% CLTV. This is for Florida now, obviously. This is a solution that's going to be more nicer for Florida, but also applicable if you can get that high LTV HELOC for your second home borrower, then they can get that 90% CLTV as well in the rest of the United States. But, Florida condo transactions are very popular in Florida. Florida is a really hot market. So it's good to know that in Florida, you can do this combo HELOC loan and come in at 90% instead of at a 90% LTV instead of 75% LTV for your primary. And also know that some non-QM conduits do have additional options for you that could give you more flexibility, where they may have a lower reserve requirement option for their full review analysis, where they may come in with 5% requirement instead of 10%. This is like where you hear them advertising non-warrantable condos kind of deal. Well, this is similar, very similar to what we're talking about here. They're going to have lower reserve requirements for the full review analysis, and they're going to have higher thresholds for the other categories for their full review process. So, again, this is an opportunity for borrowers to get better structured financing, and for MLOs to have a bigger footprint and get more transactions.
So basically, I'm sorry, go ahead, Nick.
I was going to say, we went over a few of those tricks on some of the Daily Rates Live, so check out the past Daily Rates Live shows where we've gone over the HELOC combos and some of the other non-QM options to get around the condo issues. And condo tells, definitely a popular request there. Obviously, totally outside of what you just talked about.
Right. I think the most common thing for everybody essentially would be, you look at your condo, right? You get a condo in your sites, like you said, Jose. You're going to look at that full review list and see if anything's going to be a problem. And then if it is, now we're looking at what? We're looking at, reducing LTVs of the transaction. We're looking at the HELOC solution. So essentially, we're going to have to restructure our loan before we even start it, right? And that's why we want to think about this in the first place.
Absolutely. And another issue why you want to try to do as much of your due diligence up front as early as possible in the process is because condo associations are notorious for taking a long time to complete the form. In some cases, you'll be lucky, and you may be able to pay a rush fee and have it given to you in 5 days for double the cost. But sometimes their rush could be 10 days and their usual and customary could be 21 days. So just don't wait till you're thinking you're going to have a clear to close to order the condo questionnaire, or you're going to have to be getting an extension. And keep in mind something else. This is part of your financing contingency, right? So the loans have a financing contingency approval period, which is the time that you have to meet or beat whatever you're going to do, and you don't want to all of a sudden find out that you're not going to be able to close that loan because there's a problem with the building, and your financing contingency period may have already expired. Then your buyer could be in trouble with their deposit.
All right. Well, I don't see any questions. As Nick said, you can go back and watch some Daily Rates Live trainings that we did as well pertaining to this. Remember, we do this 7 p.m. Eastern time, Tuesdays and Wednesdays. We will be back here next Tuesday, 7 p.m. Eastern. with a brand new topic. So thank you everybody for tuning in. Thank you, Nick. Thank you, Jose. We'll see you next week for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thank you, everybody.
Thanks, everyone.